Thank you so much for joining. In this session, I would like to discuss some of the key financial ratios to be used for company analysis, industry analysis, and to get a better sense of the company's performance, or if you want to compare two companies in the same or in different industries. There are 4 broad categories, and we go through step by step. So the first ones are leverage ratios. Leverage ratios basically consider the firm's long-term ability to meet its obligations and financial leverage. I would like to introduce 3 ratios. The first one is debt ratio, which is basically long-term debt divided by long-term debt plus equity. Here you see a ratio of how much debt is used over the entire capital. Second one is debt equity ratio, which is again long-term debt, but then only over equity. Gives you the same idea how much debt you use compared to equity, how much leverage you have. The other one, and sometimes this is not called leverage ratio, sometimes this is called coverage ratio, and there are some other ones which I will discuss in a later stage. But interest coverage equals EBITDA over interest. And again, sometimes we call it coverage because this tells you how much cash flow, how much EBITDA is available to cover your interest obligations. But I leave it here because it's not completely wrong. If I look at debt ratio again, how much debt do I have? Debt equity ratio the same. And then interest coverage ratio, the extent to which interest is covered by EBITDA. Number 1, let's go to liquidity ratios. Liquidity ratios, that refers to the company's ability to satisfy its short-term obligations. Here I want to talk about 3 again. First, current ratio equals current assets over current liabilities. Measures the margin liquidity, how assets can be readily be turned into cash. Then we have quick ratio, cash plus marketable securities plus accounts receivables over current liabilities again. A bit similar, we have taken out some of the current assets. So here we are not talking about inventory. So we have decreased the numerator. And the third one goes even further. Cash ratio only looks at cash, marketable securities over current liabilities. Again, here we take out accounts receivable. So what you see is cash ratio is always the lowest ratio, and then it goes up as you add more current asset items. Yeah, and again, it measures a company's most liquid assets against current liabilities in this regard. Let's talk about efficiency ratios. Efficiency ratios, sometimes also activity ratios. It's how efficiently and intensively a company uses its assets. There is one, sale to assets, sales over total assets. Yeah, the higher the number means the harder your assets work and the more revenue, sales or turnover you can generate from those assets. Second one, inventory turnover, shows how many times a company's inventory is sold and replaced over a period. Cost of goods sold over inventory. Third, days in inventory. Measures the speed with which a company turns over its inventory. And you may have seen this ratio when looking at the cash conversion cycle, which I will discuss in a separate video. It's inventory over cost of goods sold divided by 365. It's expressed in days. Then 4, again, also part of the cash conversion cycle, accounts receivable days. And then 5 is accounts payable days. And here quite similar, but here we're not taking in inventory, we're taking accounts receivables. And very important here, you're not taking cost of goods sold because accounts receivables are created when you sell your product or service on credit. So you take sales or revenue divided by 365, and here accounts payables. Again, you take accounts payables, but then here you need to take cost of goods sold again divided by 365 because accounts payables are created when you buy raw material on credit from your suppliers. Then let's talk about profitability ratios. Profitability ratios measure how efficiently a firm uses its assets and how efficiently a firm manages its operation. There are so many. I just want to give you an idea on a few. We have net profit margin. You may have seen it. Net income over revenue or sales. And you can see this directly from your income statement. 2, return on assets. Again, net income, but then over total assets. And here, as mentioned earlier, please keep in mind to translate balance sheet items with income statement items. Usually for balance sheet items, you take a kind of average to match with the income statement period. Return on equity. Again, net income over equity. And yeah, assets measure how profitable a company is relative to its assets, and return on equity shows how much profit a company generates with the money received from the shareholders. Payout ratio is another one. Earnings. Earnings here, earnings or net income is the same. Payout ratio based on your net income, bottom line, how much you pay out and how much you retain. yeah, that's all I wanted to do. There are some other ratios which I will cover in another video, but just quickly, leverage, liquidity, efficiency, profitability. When we talk about credit analysis at a later point, we will come back to some of those ratios and go into more detail. Thanks so much for joining. Bye.